Ladies and gentlemen, so we will continue with the next session. As Katja mentioned, that she's happy that we have the ECB, and we are also more than happy that we have not only the representatives of the ECB, but also other international institutions. So we continue with the policy session. We have one speaker here and 3 online, and so I give the floor to the chair, Rainer Martin. Thank you.
Thank you very much, Jan. So as you can see, this is by a wide margin the most virtual panel that we are having today, and I'm really, really grateful, Cornelia, that you are here in person, that you made the way to Bratislava. Otherwise, I would feel a little bit lonely on stage. But besides these little logistical problems, I think we have actually a very, very distinguished and very interesting panel here. So we're moving now from the national discussion on macroprudential policy implementation and the experiences with that. We're moving now to the European and international sphere, so to say. So we have speakers from 2 global institutions, the BIS and the IMF. We have Cornelia from the European Central Bank. And we have Bengt Holmström, who is an academic, but he is a fantastic authority on the field of liquidity issues. So, and he is from in the US, based in the US, so we thought it's much kinder for him if we put him in the afternoon panel rather than in the morning panel. All right, we will go again by order of appearance in the program, and I would first like to introduce Mr. Erceg, Christopher. He is Deputy Director of the IMF in the Monetary and Capital Markets Department. So, Chris, are you online? Can you hear us?
Yes, I can. Can you hear me okay?
Yes, we hear you. Good to see you, Chris. Okay, so the floor is yours.
Nice to meet you too. If you could put on the slides, please. That'd be great.
We can, yeah.
I don't hear anything. Well, thank you. I hear an echo. I wonder if
we hear you okay. We hear you well, Chris.
You hear me okay?
Yeah, we hear you okay.
Excellent.
I can't hear him.
So,
okay.
So my thanks to the organizers for inviting me to discuss macroprudential policy from a global perspective. So the usual disclaimer applies. These are my own views. So the next slide, please. So to outline my discussion, I'll begin by noting that the resilience of the global financial system post-pandemic suggests very strong benefits of the post-global financial crisis macroprudential frameworks that were put in place. I'll then complement this by presenting some selective empirical evidence showing that macroprudential tools are effective. And then I'll proceed to discuss some of the challenges ahead, including some focus on the implications of upside inflation risk, and following up on the discussion in the last panel on interactions between monetary and macroprudential policy. Next slide, please. Next slide, if you could, please. Yeah, thank you. So the pandemic and inflation surge of the past couple of years have been really a major stress test of the macroprudential frameworks that were put in place following the global financial crisis. Our experience thus far suggests that these frameworks have performed very well in boosting resilience. The resilience is especially impressive given that the inflation surge and sharp consequent tightening of monetary policy seen in the lower left panel was not only the biggest in several decades in advanced economies, but also a surprise, and well outside the realm of what might have been considered plausible before the pandemic. The financial sector has generally performed well in the face of these shocks, and financial conditions have remained quite easy in many economies, as suggested by the price-based financial conditions measures at right. The broad-based concern that advanced economy policy tightening would generate large capital outflow pressures from emerging markets and pummel their currencies also hasn't materialized, at least for major emerging markets. So there's something to celebrate on this 20th anniversary, even while cautioning that difficulties could arise, especially if inflation is more persistent and unemployment rises more than expected, as I'll turn to later in my presentation. Next slide, please. Actually, next one. Yeah, thanks. So the financial resilience we've seen around much of the globe has been supported by rigorous financial assessments at both the national and supranational level, as well as by the deployment of key macroprudential tools, and those have been discussed quite extensively in previous presentations. The latter have included a major strengthening of capital and liquidity buffers, including by emerging markets, as shown in the right chart, showing how Tier 1 capital has risen substantially since the global financial crisis in major emerging markets. Moreover, the toolkit of borrower-based tools has expanded progressively and been more forcefully deployed. Next, please. So there's substantial evidence that these tools have been effective. High and releasable capital buffers reduce pressure on banks to cut lending during downturns. Recent literature, including by my fund colleagues, has showed that both capital and borrower-based tools can shift and reduce tail risk to GDP when financial conditions tighten, using a growth at risk framework that employs quintile regressions. And innovation is that it focuses on something closer to the objective of policymakers rather than an intermediate target such as credit growth. Some results are illustrated at right based on cross-country data for advanced economies and emerging markets. The blue line shows how an easing of financial conditions initially boosts GDP growth, even the lowest decile of the GDP growth distribution shown here. However, this tail of the GDP growth distribution then dips sharply after a couple of years, implying that easy financial conditions today spell downside risk to future GDP growth. The use of macroprudential tools, the red line, can succeed in making these downside risks less pronounced. Some interesting related research also shows how strong bank capital improves monetary transmission, so there's less risk of a big rise in credit spreads when monetary policy tightens aggressively. I'll come back to that later. Moreover, the cost of building buffers is typically estimated to be quite modest. Next slide, please. The literature has also shown how borrower-based tools can also be very effective, including in reducing vulnerabilities from high leverage. Information based on granular household-level data can help pinpoint how to calibrate tools effectively and appropriately. The chart at right, based on research by my colleague Erlen Neer, shows estimates of how default probabilities vary with debt servicing to income ratios, DSTIs, using credit registry data for Romania. Default probabilities are negligible for DSTIs less than 30%, but begin to rise sharply with higher DSTIs. The upshot is while DSTI limits can be very useful in reducing financial stability risks, it's also important to be attentive to the marginal costs of calibrating these tools too tightly, which can hurt the welfare of borrowers aiming to get a mortgage while doing little to reduce financial stability risks. Next slide, please. Great. So now I'll pick up to what was discussed in the last panel briefly. And while the resilience of the financial system is encouraging, there are a number of gaps and challenges ahead that pose systemic risks that must be addressed by macroprudential policy. Well before the pandemic, it was recognized that the authorities often have limited tools to address risks in non-banks and corporates. Following the bank failures in March, it's clear that there's a much greater risk of rapidly evolving bank runs given significant digitalization in social media. Again, this was discussed in the last panel. And then we're also likely to face risks from a more volatile environment with increased trade fragmentation and increasing climate-related risks. And we also must work to ensure that the benefits of rapidly transforming forms of digital payments can be harnessed, while at the same time containing the attendant financial stability risks. And my focus in the remainder of the talk here will be that macroprudential policy must really confront the challenge posed by much more upside inflation risk than what was envisioned pre-pandemic. So in this, I'll consider some of the monetary and macroprudential interactions that were also raised in the last panel. Next slide, please. So as brief backdrop, macroprudential policy in advanced economies was largely forged in a low inflation environment with a low neutral rate. And monetary policy focused on downside risk to inflation, given limited policy space. And the combination of resource slack and the perception of a flat Phillips curve meant there was very little perceived inflation risk. In this environment, there was a strong confluence between monetary and financial stability objectives. Central banks could lower rates to ease emergent financial strains, which also reduced the risk that inflation would drift down. Next slide. We're now in an environment of much more sizable inflation risk. Continued high inflation poses financial stability risks in the near term. But upside inflation risks may persist for years to come. There is a significant likelihood of more volatile global supply shocks due to trade fragmentation, as captured by the dramatic escalation of the number of new trade restrictions imposed globally during the past few years that are shown in the bottom chart. And there's also greater risk of supply shocks due to the climate transition. So in addition, the experience of high inflation suggests that the Phillips curve may be considerably more nonlinear than was envisioned, so that there's more risk of inflation rising, perhaps sharply, and monetary policy needing to act aggressively. These structural changes, which matter globally, could have profound consequences for financial stability and correspondingly for macroprudential policy. Next slide, please. In the current context, more persistent inflation than envisioned by markets and the need to tighten monetary policy could generate significant repricing of assets around the globe. Of course, we've seen some of that already. The tighter policy stance could translate into heightened strains for highly leveraged borrowers with heavy duration risk, especially in interest-sensitive sectors such as real estate. Banks and other financial institutions could face bigger valuation losses on government bonds and other safe assets. And unemployment could also rise markedly, intensifying credit risk. From a cross-border perspective, tighter policy in the US and other advanced economies could weigh on emerging market currencies and intensify the policy challenges of emerging market central banks. Next slide, please. So central banks may face greater tension between price and financial stability objectives than under the low inflation environment pre-pandemic. Price stability may require central banks to raise interest rates sharply, even in the face of financial market stress, and thus exacerbate rather than counter it. Given that large and rapid interest rate hikes may be needed, there's likely to be more uncertainty about monetary policy transmission, whether the hit to the real economy may be much larger than expected, so higher than the modal assessment, and may have unintended side effects. So in an environment with upside inflation risks, whether now or sometime down the road, It poses central banks with some pretty difficult trade-offs. Aggressive policy tightening risks a blowout in financial markets in an unnecessarily large economic downturn, while a softer approach risks allowing inflation to remain entrenched. So next slide, please. So ex post tools and actions, including various forms of central bank liquidity support and asset purchases, can help navigate and ameliorate these trade-offs. Such actions, especially if accompanied by forceful fiscal backing, can allow central banks to better achieve price and financial stability goals. Central banks and fiscal authorities have succeeded in this regard during various episodes of financial stress during the past year. We've seen that around the world. However, these tools may have shortcomings in some situations. Central banks are well equipped to address liquidity, but not solvency problems. And problems in the non-banking sector, even from liquidity, may be out of their reach. Fiscal space is also needed, but may be unavailable, especially for some emerging markets. And the use of these tools may raise considerable communication challenges, for example, if deployed when policy also needs to be tight to contain inflation. And they may also raise political economy challenges. Next slide, please. So while these tools should be used if central banks reach a tipping point, macroprudential policy can reduce the risk of getting to that point. In particular, stronger capital buffers can reduce the risk that monetary tightening causes significant financial market stress, consistent with evidence I briefly mentioned that better capitalized banks experience smaller rises in funding costs during policy tightening cycles. In this vein, it seems desirable, conditions permitting, for countries to further build buffers that can be released should stresses materialize. Stress tests can also be refined to better take account of interest rate risks that come from the need to respond to higher inflation. And interest rate risk can be addressed through targeted tools as well as heightened supervision. All told, strengthened macroprudential measures should both help to build resilience to interest rate risk associated with high inflation and make central banks more confident that they can tighten policy sharply if needed without risking anything too cataclysmic. Next and final slide, please. So to wrap up, I'll conclude by noting that containing financial stability risks in an environment with more upside inflation risk shouldn't rest entirely on macroprudential policy. Given what we've learned in this recent high inflation episode, central banks may need to reconsider some policy actions or strategies that could easily lead to overheating. Moreover, given the huge rise in public debt since the pandemic, there is a need to rebuild fiscal space to provide buffers critical for addressing future macroeconomic and financial stability risks. Thanks.
Okay, thank you. Thank you very much, Chris. So I think this echoed some of the points we had also in the previous panel, and we can get back to this in the Q&A session. So I would now like to turn to Professor Bengt Holmström. So Bengt is Professor Emeritus at the MIT. And in addition to this, I should point out that he won the Nobel Prize in Economics in 2016. Quite remarkable achievement. And he did that with a focus on his research on the theory of contracting and incentives. And he's also a very known specialist in liquidity problems and financial crisis. And that's also what I asked him to focus on in this presentation. So, Bengt, the floor is yours.
Thank you. It's a pleasure to be part of this conference. I would rather have been in Bratislava, but this is the reality. I have followed some of your discussions in these sessions this morning. It's morning here, and I feel a little bit like a dinosaur in the sense of where you are. I'm not an expert on macroprudential regulations, on regulation in general. I'm a theorist, and so I will talk about what we have named, my co-authors, Gary Gorton and Tri V. Dang, have called the information view of financial crisis. And some of these may sound very familiar and sort of not that pertinent perhaps, but I think it's important to really understand the theoretical structure and the logic, even such things as logic or debt. You know, when I presented these kind of ideas at the BIS conference in 2014, the annual conference, I was amazed to see that this was news to just about everybody. So I think it has. This is 10 years ago almost. So this is. Some of it will be very not old hat, but let me speak to it in any case, because that's what I have been interested in, and I hope there will be new insights as well. Basically, my main message to just is that one of the big mistakes pre-say a global financial crisis was to think that debt and money, bonds, debt and bonds, so even short-term bonds, they are all, you know, they can be priced out, you know, using what we call the state price view. That is, you know, we have a price kernel, and we just stuff in, you know, what the payoffs are from the instrument we want to price, and out comes an answer. So this is of course everywhere in textbooks, and this view of sort of state space view really got to dominate all of finance. And I think also flowed into the views that people had on financial markets and even banks and such things. There were some exceptions. It is a very mistaken view, in my view, that one of my main messages is that money markets, which means short-term debt markets, you know, they are just the opposite of, say, stock markets. And so all the insights, never, ever draw insights from stock markets onto money markets, because they operate on entirely different logics, and big mistakes are made. And I think it was very visible in the initial reactions to the global financial crisis, where people asked, why didn't we ask any questions? You know, why did Wall Street trade without asking any questions? And most people, including myself, incidentally, thought, well, transparency, we got to get to transparency. Wrong. I think entirely wrong. You know, these money markets are not at all about transparency. They are all about, in some sense, opacity. They are silent markets. They are markets where they're trust-based. They are not based on discovering some prices, really, you know, even of assets. And this is this. I want to bring this up. I will elaborate on it and give examples of it. But I think this is sort of the central theme. This slide contrasting money markets and stock markets. I don't have that slide with me, but I will tell about it. You know, I never got beyond that first slide at my BIS presentation. I think I had 7 slides, and I didn't get past number 1. Which was this contrast between money markets and stock markets. So that's one thing I want to really emphasize and bring up again, and then point out that even this sort of relatively simple view has some regulatory implications, and talk about that. And they are not about details; they are about principles that can be drawn just from this simple view of information. So information is at the core of all that happens in financial crisis, and it's always information about short-term debt. And the assets that back it up, as reflected in a lot of these discussions that we have heard today. So that's what I want to discuss, and let me then jump right away to the question of what is different between money markets and stock markets. And And as I said already, that the sort of initial reaction to the global financial crisis about gets to more transparency is wrong, because money markets and debt in general, one might say, it's not about price discovery really at all. I mean, bonds, yes, but bonds are a very small fraction of the market. So if we talk about short-term debt, it's not about discovering the price of short-term debt. Short-term debt is supposed to be priced at par. And anytime it deviates from par, even a little bit, we have a problem. So this is not, we are not discovering a price because it's also, of course, it varies with interest rates, but that's a different thing. But if we talk about sort of the credit risk, it should be zero essentially. So we call this, short-term debt needs to be information insensitive. And if one takes that view, everything that is done about regular things about short-term debt is about preserving that information insensitivity. That includes the case when you are in a crisis. The only way out of crisis is to get back short-term debt that's information insensitive. That's a very simple prescription that comes out of this theory. So let's understand that we are not in the the market sort of isn't there to look at these prices. I mean, the reason is very obvious. We are turning over trillions of dollars every day. We have to, refinance it by, say, take the shadow pricing market. We roll over, trillions of dollars every morning, either automatically or by phone calls. And there's no time to start thinking, should, explore, is this a credible instrument or so on. So we do it simply by over-collateralizing this debt sufficiently. And we never go and try to figure out exactly what the value of this underlying debt. So the question of why didn't anybody ask questions is because it was impossible to ask questions serious questions in the case of the structured finance instruments on Wall Street. Thousands of small pieces of debt were in these portfolios. And they were, I think, we make the somewhat more controversial, perhaps, claim that they were really there to actually make the instruments opaque. So opacity tends to make things more liquid. So there are two ways to get to liquidity, basically. One is really high levels of liquidity, not asking any questions. One is to have everything all the time on the table. That's what happens in stock markets. You see the values every nanosecond, you see what the prices are. The other is to make everybody have symmetric information by not knowing anything or not needing to know anything. And that's what the money markets are all about. There is no need to ask questions. So no questions asked is what we are striving for. And opacity, it turns out, tends to help with this. Course ratings, for instance, is a purposeful instrument to make this opaque. You look at money market funds before the global financial crisis, they reveal information about money market, assets only 4 times a year. And when they revealed the information about it, this were a regulatory requirement pre-crisis, they reported what the values were 60 days before. They didn't even tell us today's valuation. And now, so the prediction is that if you reveal this information every day, then it's not going to serve any more longer as a money, because it's a suggestion that people should really follow what the underlying assets are worth. And indeed, if you look at what happened when they regulated the money market funds and demanded sort of a floating knob every day, NAVs should be revealed, they lost their moneyness. The portion of the money market funds that didn't have just simply the U.S. Treasury bonds and such in the highly creditworthy assets behind it, then they basically lost their moneyness, and half of the assets dropped out in the U.S. because of this. So you see that the transparency has a big effect on whether, how liquid this market really is and what nature the liquidity is about. This, incidentally, I think was a good thing. So you see, transparency can be good but not because it makes it more liquid, as in asset market, in stock markets. It's because it makes money markets less, or a money instrument actually a non-money instrument that is takes away liquidity from the money market, and so I think it was a very good move, but for a very different reason than we usually think about transparency. The other thing is that this is very cheap. The money markets are very cheap, very little information collected. Of course, big investment in stock markets. And the reason for that is obvious, because there's nothing to investigate, really. That's the state in which you want to be. And one of the critical things for money markets, which gets us to the possibility of crisis, is that it's urgent. Every day we have to turn over these things. So if there is a hiccup in markets and somebody starts asking questions, is this really actually worth $1? Is it $1? We are already in a financial crisis. This is very much what Bagehot said, when the banks have to start explaining how their credit worthiness, they'd already lost it. So, any effort to try to explain, open the book, so to speak, and explain, it's game over. And we are already in a financial crisis. So these are extraordinarily different. So there's very steady volume in money markets, very stable valuations. That is, everybody believes it's at par, and that's the nature of it. So, as I said, opacity, various things can be done to make it even more liquid. So shortening the duration of debt instruments makes them more liquid. One of the very bad things, so here is a very critical issue that's different from stock markets. Stock market advice is just diversify. Diversify. The ideal portfolio is the so-called market portfolio. This is the theoretical idea. Everybody of us should hold a slice of the American, or maybe today global portfolio. It's of course not happening, but the idea is diversification is very good. Look at money markets. We thought, and I remember this being talked about, that in the build-up of more debt before the global financial crisis, there was talk about we don't have to worry so much about the levels because they are well diversified. You went into different banks, and the banks did not have some big, accumulation or concentration of debt. The problem is, if you keep diversifying enough in money markets or in debt markets, actually the tail risk just becomes enormous. And we saw it in what happened in the global financial crisis. The big surprise was that what we thought were uncorrelated things suddenly were very correlated, because suddenly we were at that tail event when the instruments became essentially equity-like. That is, they were no longer worth the par value, and the whole sort of basis for how you value them changed. And we really had to start discovering what these assets were worth. But there was no market for discovering assets behind it. So you see that the problem, that's what is so cataclysmic about as soon as people start investigating what's behind this, and I'm excluding here regulators, we are in trouble. And diversification, this is perhaps my strongest warning to you people who do regulation. Beware of diversification. I mean, to some degree, if you diversify a little bit, you will get more liquidity, but you will get more and more liquidity by pushing risk into the tail. And think about if every bank held exactly the same portfolio, and what would happen if one of them would go down. They would simultaneously, all of them, go down. So that's a way of thinking about the fund. And now we have to have price discovery in a situation where we had no idea how to discover even the prices. Speaking about that, I might mention that the initial thought when 700 billion was given to the Fed was that the Fed would buy out the toxic assets, from the banks. What a crazy idea. There's only one way to get back to a stable system again. That is to bring back the no questions asked regime. That is, do what they eventually did, which was that they recapitalized the banks. So we have to understand that banks are part of the banking system. I mean, the Fed, in some sense, they distribute Fed money. You know, they are intimately connected with the Fed, obviously, and the Fed is the one who should rescue them. If they should also regulate, of course, but they should rescue them if something happens. And so this is another example. And here I was actually with my co-authors involved, you know, in arguing. I'm sure others argued also. I said, for God's sake, don't start trying to buy up toxic assets. Well, how would you know when you have bought up enough toxic assets? Is a good question. And it was something that one could draw on here on the big financial crisis in Finland. In Finland, where I am from, but in Sweden, the Nordic crisis in 1991. You know, they did the right thing, in my view. And it's always going to be the right thing, is to, you know, bail out the system. But we have to, one can do it smartly or one can do it less smartly, and you are more expert on how to do it than I do. And so this has now explained, so these simple ideas are you know, if one gets the right mindset, that's what I'm trying to communicate here. In the right, what is this money about, and what is the idea? You know, then I think a lot of these insights will seem obvious, but never. Let me give some examples still. Like, think about the European crisis that followed or was part of the global financial crisis. You know, Mario Draghi said whatever it takes, and suddenly only then did the spreads come down. How opaque was that comment? What did it mean? My point is, it was crucial, and nobody understood really what it means. You can't put you know, whatever it takes into a spreadsheet and start calculating when it will break down. And that uncertainty was actually crucial, in my view, to why it was successful. Of course, we understood that there were a lot of new assets coming into play, but it's just one of the lessons from sort of this perspective. There are a lot of other examples. I gave already the MFF example. I think the SVB was unusual. Let me close by saying that there's the view that all crises are the same, and how stupid are we? You know, every time we take too much money and then we go over. I think that's an utterly naive way of thinking about this crisis. The crises are, and in the end, they are all the same. There's a collapse. But before you get into the crisis, they can happen in a lot of different ways. The global financial crisis actually was running in the shadow banking system for a year before it came into the open. And one of the interesting things is that the thing that undid, that the key moment in that crisis was that the highly regulated and visible and transparent system, namely the tri-party market, that market was ultimately the cause of the collapse. It didn't happen in the and that has to do with the fact that in the shadow banking system, you know, or in general with how these adjust these markets, they adjust the haircuts, and in the tri-party system, they didn't adjust the haircuts because they were basically much safer as a system until they weren't safe again. In the shadow banking system, there was a continuous adjustment of the haircuts, but very few people knew about it because they were over-the-counter markets. But it happened for a year, from the summer of 2007 to, you know, until the Lehman crisis. And so, again, this is an example of how, you know, information plays a key role here. In the shadow of the shadow banking system, there were adjustments. When it comes to debt, they basically always adjust by quantities, not by prices. So I hope this has been a passionate, a somewhat passionate plea that, you know, we must never take advice from the stock market, but we must be aware that the stock market prices can actually communicate information, for instance, about banks. And that's one of the issues that you should look into when it comes to regulating banks. They seem to tell a story on the stock market side rather than the banking side. And so let me stop there.
Thank you. Thank you very much, Mr. Holmström, Professor Holmström. It was very interesting. I think this was thought-provoking, I have to say. And of course, liquidity measures are part of the macroprudential toolkit, but maybe it's just my subjective impression, but I have the feeling that they're getting a little less attention sometimes than those measures related to capital-based instruments or borrower-based instruments. And that may be a mistake, because as you also mentioned in your examples, I mean, we saw it now with Silicon Valley Bank, and there was not a problem at all on solvency, of course. And things can happen very, very quickly if you get the liquidity regulation wrong. So let's. I hope we'll get back to this also in the Q&A. Let me now turn to the third speaker, Cornelia Holthausen. Maybe you move a little bit out of the start. Cornelia is with the European Central Bank. She's Director General of Financial Stability and Macroprudential Policy Department, I think since 2021, if I'm not mistaken. And so I've known Cornelia actually for many years, because I was also many years at the ECB, and she worked in various parts. So she's a very good example of mobility within the institution. I think you were in economics, market operations, research, covered pretty much everything, I would say. So thank you, thanks very much for coming, and the floor is yours.
Thanks very much, Rainer. I'm very happy to be here at this conference. And you asked me about, how do we do macroprudential policy in the euro area or in the SSM area, and give some institutional background and share our experiences. And let me also say that what I say here today are also my own thoughts. Yes, this works. Thanks very much. So, macroprudential measures in Europe, they have, of course, existed also before the financial crisis. But let me, you called the conference 20 years of macroprudential policy in this area. So I don't really know what happened 20 years ago. So let me cover the last 9 years, and start with the 2014, of course, with the creation of the single supervisory mechanism. Also, the macroprudential framework for the SSM was designed, and the legal basis was set up in these various directives and regulations. But it was also refined over the next years to come. And we have a complex system, as I'm sure my colleagues from the national central banks that were in the earlier panel have already alluded to. So we do have it's basically a national competence, like also Governor Casimir was asking for earlier this morning. But there are elements that are important to ensure consistency on the euro area-wide level, and the ECB and also the ESRB, they both have a role to play. So it's actually really quite a complex system. So the NCA, so the national authorities, as I said, they have the power to suggest and to implement macroprudential measures. Who are these authorities? That varies across countries, because the macroprudential function is sometimes embedded in the central bank, sometimes on the supervisory side, or also there are often committees, so the finance ministry is sometimes involved. So there's not one solution across all countries. Then the ECB. Of course, on our tasks, we have a mandate to also care about financial stability and regulatory policies, and the ECB is consulted when these proposals are being made. We do have the possibility to voice an opinion and also to do a top-up, so to complement the policy and demand a more stringent approach as regards capital buffers. But I should say it's an asymmetric power, so the ECB could only, in theory, top up, but it could not say, "Oh, please reduce the macroprudential capital buffers," as I think it's an element that is meant to avoid inertia and to avoid a bias for having a too low buffer. And then, of course, there's the ESRB. They have an oversight function, and they, for instance, they issue warnings and recommendations in the macroprudential space for all the countries in Europe. And the idea of the whole setup is to, yes, leave this decision on macroprudential powers at the national level, but to ensure that they take timely action. And the ECB's role is, first of all, to see that we have a consistent approach across all the different countries, and also to see whether they are, and to incorporate any potential spillovers, if any, between these different countries. So this all then implies a relatively complex setup with a lot of interaction. So the governance is really quite complex. We have some interaction between the ECB supervisory side and financial stability side, where I am, because ultimately the decision-making body is the so-called macroprudential forum, and that's a combination of the governing council and the supervisory board. So when the national authority makes a proposal, we have a lot of or intends to make a proposal, usually, we have a lot of interactions among us and discussions with the national authorities. Do we agree on the assessment? Do we agree on what would be the appropriate measure and how high and when? So there's lots and lots of interaction, and I think very often we also agree in very broad terms with the colleagues on the national side and on the ECB side. And that's really the idea, to have a common understanding and have a more sound idea and more confidence that it's the right measure to take going forward. So the ECB then, when we receive such a proposal, we make an assessment, and there's an objection possible, even though it's not binding, unless we have this top-up proposal, but that has actually never happened. But I do have the feeling, so with the limited experience that we have, I do think that having the top-up power is also helpful for the national authorities in their interaction with other bodies that are involved in the macroprudential decision, because it's quite a threat, such a top-up, to think that the ECB would do something on top of what the national authorities have found or communicated as the wise choice. So we try to get in these discussions a common understanding, and what are the proper measurement of risks, what are the appropriate instruments, and really to have a homogeneous approach. And my colleagues who were speaking earlier here today, many of us sit in the Financial Stability Committee, for instance, where we also discuss these type of issues. Now, from our perspective, the primary objective of the macroprudential toolkit is really to build resilience, so to enable the financial sector to give them the ability to absorb losses and to continue providing credit in all times. And I think this is what Ricardo also mentioned earlier today. So on the capital measure side, it's really to improve the resilience of banks, and the borrower-based side would then improve the resilience of borrowers, which is then also important for banks because you have lower default rates and lower credit risk and so on. And I think it's maybe a secondary or an intermediate goal, this idea to tame the cycle, as was also mentioned earlier. And I think it was Javier who said, we don't even know whether we can actually manage to do that, to tame the cycle with macroprudential measures. But for me, that's maybe one reason why I would really focus on the idea that building resilience is the main objective. And I think that earlier this year in the March, I call it a turmoil, not a crisis. So in the March turmoil, we haven't seen spillovers, luckily, severe spillovers to the European banks, to the banks in the euro area, I should say. So, and I think the main reason was really that banks are very well capitalized and have good liquidity buffers. So I think the resilience aspect was key. I fear that if the same type of events had happened a couple of years earlier, we would have been in a much worse situation, and I would not have excluded that maybe we would have had more spillovers. So I do think resilience through the macroprudential framework and generally capital measures really helps. Let me walk you through what has happened in the SSM countries since 2014. So in the early years of having the macroprudential buffers, there were already some mainly measures that have addressed problems in the real estate sector. And you see here this little chart how that is also a sector where we have seen consistent growth over the first years. So most of the measures apply to that. And I list here, there's really a number of countries that have introduced borrower-based measures or have introduced risk weights that are related to real estate exposures. But we have also seen 5 countries that increased systemic risk buffers, and that was mainly related to concerns about the size of the banking sector. And we have seen 7 countries that had introduced some countercyclical capital buffers, but I should say in a rather timid way. Because if you compare during that time, capital ratios across the board strengthened a lot, after the financial crisis, and I think before the pandemic hit, the CET1 ratio was almost 15%, but the average countercyclical capital buffer stood at 0.11%. So it was really minuscule at that point in time. So then during the pandemic, sorry, this was animated. I forgot about that. I had completely forgotten about it. Well, okay, so let me then turn to, here you see over time how this has all evolved. Okay, then during the pandemic, that was then the time to release, no? So, and various micro and macroprudential measures then freed actually capital. So you see here on the left-hand side, basically in a very simplified way, the capital stack before the release, and then there were several measures on the micro and the macroprudential side that were then, that provided some buffers that were freed up for the banks. And only 6 billion were freed up by releasing the countercyclical capital buffer, so not a lot, but no surprise given that it was at very, very low levels before. And because of that, because there was so little of this releasable capital available in the system, actually some countries decided to release some buffers. They were not meant to be releasable, but they did it anyway under these very special circumstances. And I think there was the systemic risk buffer and the OC buffer. And what we learned during that time was really how important it is to have these releasable buffers. We have some studies at the ECB that look at how banks behave once the level of capital approaches the threshold below which they are not allowed to pay dividends and so on. And they do change their behavior, so they're much more reluctant to give credit to the real economy once they get closer to that limit. And that may be because they actually fear breaching the limit, or it may be because they fear stigma effects in the market, or because they fear more supervisory scrutiny. I don't know, I guess it's a mix of all of these different reasons. So we do see that really curbs lending, and so that then in that case that was would act in a pro-cyclical way, which we want to avoid. But on the other hand, we do see that these measures that were taken, the freeing up of capital, really helped and were effective in avoiding pro-cyclical behavior. But we would have ideally liked to have larger buffers earlier on, so we could have released them in a proper way. And that would have been helpful for the economy. Now, what happened after the pandemic? Now we are in a very new kind of situation. I think Christopher already alluded to it a little bit. No, there's new environment of these massive shocks coming from the outside, having a war in Europe all of a sudden last year, high inflation, rapidly rising interest rates. So that's really an environment that hadn't been tested in terms of macroprudential policies. And what was said earlier, that it's so important to understand the interaction between monetary policy and macroprudential policy, I think a lot still we need to study and need to learn on that. So, and it put macroprudential authorities in a difficult position, because on the one hand we have a turning financial cycle, so credit growth is adjusting downwards. There are adjustment in residential real estate markets, which were the key problem before. So you could say the cycle is already tamed in some way. There's maybe not so much that we need to add to that. And also a war breaks out. It's difficult also I think you mentioned communication in an earlier panel, no? It's difficult to communicate how in such an environment you should actually increase buffers where banks are fearing fallouts due to credit risk and so on. But at the same time, this was a moment when the vulnerabilities that had been built up before, they still persisted. So the level of indebtedness was still very high. Plus, it is a time, as you know, when banks are reaping extraordinary profits since we lifted the interest rate so much down from the negative interest rate environment. So they have buffers right now. So it wouldn't be very costly to implement further buffers. And so the procyclical elements are probably contained if this was done. And especially if you look forward and think, okay, we have such a difficult situation. We know that the high interest rate environment may affect profitability of corporates and so on. So it is a situation where credit risk may rise. So it would be prudent to have these buffers. And definitely, I think in this situation, so we have had a lot of political pressure now on the banks and the high profits, and we have seen some countries who have started now to impose taxes, to tax these profits away. Well, I would say much better for the banks to keep these as buffers for the worst times maybe to come, and then we also don't need to bail them out. So I think it's a bit a short-sighted thing to have all these different tax discussions now. And Javier mentioned earlier, I don't know whether you really meant it, shouldn't we trust banks themselves to hold more capital buffers and to really, to take this decision themselves? And there should also be, have incentives to do that and to hold sufficient capital, but especially right now, I really do think that the markets underestimate a bit the potential downturn that could come. So I wouldn't trust them so much at this point in time. Okay. I think I'm also coming to an end. Let me skip this one. So looking ahead, Martin Hellwig said this morning, do we know what we're doing? I think we know partially what we are doing. We still have a lot to learn. So about how the importance of macroprudential space and the usability of buffers. I think there's a lot already going on. As said before, the interactions with the monetary policy, with microprudential policy and crisis management frameworks is something we need to study now that we are in a very different monetary policy environment. We still should think about the framework, the calibration of the buffers, how they interact with each other, and also when is time to start to release the buffers. And I heard several people mention before the complexity. I think the complexity is too high, so ideally we could also try to tackle that, what level of complexity we really need. Then very important, I think, the non-bank financial institutions, they are really still a very opaque financial sector. They are growing in importance. They are providing, I think, almost double as much lending to the real economy than they did just a couple of years ago. So it's something that we should really watch out and try to also have a macroprudential framework, because through that sector, any stress that can occur can really amplify. And I'm thinking here about ensuring that these institutions are prepared in terms of having sufficient liquidity. You could try to look at the angle of reducing the liquidity mismatch, in particular for money market and investment funds. And there's an issue of leverage. These institutions are often very highly leveraged. And so there's really potential to trickle through the system. Let me close here. Thank you very much.
Thank you. Thank you very much, Cornelia. And some of the points you raised at the end are, of course, going to be discussed tomorrow morning in the session 4, which is actually also called The Brave New World for Macroprudential Policy.
Oh, really?
So it's exactly the same title. And there we will look also at non-banks, for example, and the climate change. So we'll discuss all of these issues. Again, thank you very much. It was very, very interesting. And I think there's lots of discussions that we could have and hopefully will have in the Q&A, because I think it also echoes a lot of the points that were raised in the previous session. But before going to the Q&A, let's have then the last speaker in this session, and this is Boris Hoffmann. Boris is head of monetary policy in the Monetary and Economics Department of the BIS. And before taking this role, he was in the BIS in various other functions. And he was also working at the ECB for some years in the Monetary Policy Strategy Division. So, Boris, the floor is yours.
Yeah, thank you very much, Rainer. It's a great pleasure to be here today, even if unfortunately only virtually. In my presentation, I will focus on macro-financial stability frameworks and the challenges arising for them from external financial conditions, drawing on recent BIS work on that topic. And of course, also in my case, the usual disclaimer applies. So all I'm going to say in the following reflects my own views and not necessarily those of the BIS. Next slide, please. So my presentation is structured in two parts. First, I will give a short introduction on the nature and the origins of macro-financial stability frameworks. And in the second part, which is the actual substance of my presentation, I will then focus on the challenges posed to these frameworks from swings in external financial conditions. So I will talk a little bit about the policy trade-offs raised by swings in external financial conditions. So Chris has already talked about that, so I will be very brief on that. Then I will briefly describe the implications of these trade-offs for macro-financial stability frameworks, for their design. And then the last point will be on the macroprudential features of FX intervention. So I thought this could be an interesting additional perspective that could be brought to the discussion. Next slide, please. So let me briefly describe the nature of macro-financial stability frameworks, the concept developed here at the BIS. So these are policy frameworks that are designed to durably safeguard macro-financial stability. First, by mitigating the buildup of vulnerabilities, and second, by building policy buffers to enhance resilience. So in other words, the idea is that the whole framework would have macroprudential features. So it would go beyond the macroprudential tools which are part of it. Now, the elements of the macro-financial stability framework, so this, first of all, of course, includes monetary and fiscal policy, which play a key role in maintaining macroeconomic and financial stability. And we have devoted a special chapter in this year's annual economic report discussing this role of these two policies in detail and the interaction of these policies, in particular at the current juncture. And then the frameworks, of course, also include complementary policies, in particular, of course, macroprudential policies, but then also other policies, and here, in particular, also FX intervention, on which I will focus later on. Next slide, please. Now, the origins of the macro-financial stability framework. So the concept, of course, has similarity with the integrated policy framework concept developed at the IMF. The macro-financial stability frameworks, they have a long history, as many things at the BIS. So when you look at early reference or mentionings of that concept, so there's a first discussion, a speech by Andrew Crockett in 2000, and there were already discussions of this framework in BIS annual reports in 2004, 2005, and also 2008. And more recently, there has been a greater focus of the challenges for these frameworks from swings in external financial conditions. So there was a BIS special chapter focusing on the challenges for EMEs in 2019, and there were subsequent reports by member central banks in Latin America and Asia, so from the ACC and the CCA. And last year, we also published a report to the G20 finance ministers and central bank governors on that topic. Next slide, please. Now let me turn to the main part of my presentation, the challenges to macro-financial stability frameworks posed by external financial conditions. The challenges are particularly relevant for emerging market economies due to their shallower financial systems compared to advanced economies, which makes them more vulnerable to swings in external financial conditions. So there's also a point that Chris has already mentioned earlier. And the essence of this challenge can be summarized by this chart here, which shows the correlation between the change in the local currency bond yields and the change in the local currency exchange rates against the US dollar in EMEs. So the red line is the change in the local currency spread, and the blue line is the average change in the US dollar exchange rate. And what you see in this chart, that there's a very striking negative correlation between these two series, between these two lines. which essentially implies that a tightening of global financial conditions, which is commonly reflected in dollar appreciation, is associated also with a significant tightening in domestic financial conditions in emerging market economies. And here it's important to emphasize that what we are looking here are the change in sovereign spreads in local currency. Yeah? So it's not the foreign currency, which basically reflects the original sin redux, which has been highlighted in recent BIS work, as this essentially suggests that the external financial conditions, they affect the domestic financial conditions in emerging market economies, even if borrowing occurs in local currency. So even if there's no original sin in terms of borrowing in foreign currency or dollar. And the mechanism behind that is essentially that the currency mismatches, they have essentially shifted from the borrowers to the lenders when the borrowing occurs in local currency. Next slide, please. Now, the impact of swings in external financial conditions on domestic financial conditions gives rise to a number of difficult monetary policy trade-offs. On the one hand, there's an intratemporal trade-off because inflation and output may be pushed in opposite directions. Yeah, for instance, capital outflow may, on the one hand, be inflationary because it's associated with the depreciation of the domestic currency, and at the same time contractionary because it's associated with the tightening of domestic financial conditions. Or at the same time, there is an intertemporal trade-off because short and long-run risk price stability may be affected differently. For instance, the capital inflow may be disinflationary in the short run because it's associated with currency appreciation, but at the same time, it may promote the buildup of financial imbalances because it's also associated with the loosening of domestic financial conditions. Now, the work that we have done at the BIS and also the work that has been done at the IMF suggests that macroprudential tools and also FX intervention, they can improve these trade-offs essentially by leaning against the buildup of imbalances and also by enhancing resilience. Next slide, please. And this is also reflected in the design of macro-financial or policy frameworks in emerging market economies, which very often combine inflation targeting with FX intervention or the accumulation of large FX reserves and the frequent usage of macroprudential tools. So this is what you see here in this chart. On the left-hand panel, you see that a growing number of emerging market economies have adopted official inflation targeting monetary policy regimes over the years. The middle panel shows the large FX reserves that has been built up in this group of countries over the last decades, which has recently come down as they were basically leaning against the impact of tightening of external financial conditions. And the right-hand panel shows the familiar picture of the frequent use of macroprudential tools, in particular in emerging market economies, which is the blue line here, and the red line are the advanced economies, which shows that in EMEs, these tools are relied on more frequently. Next slide, please. Now, since Chris has already covered the role of macroprudential policies in improving trade-offs, I thought it might be useful to cover the other complementary policy instrument that I had shown in the previous chart, which is the role of FX intervention, and also to highlight the macroprudential features of this policy tool. Now, the macroprudential features of FX intervention are twofold. On the one hand, reserve accumulation for precautionary motives that can essentially serve as a self-insurance against large devaluations and capital outflows and the repercussions on macro-financial stability, which basically means that central banks, they intervene in the market, but they do not do so in order to have an effect, but it's rather to build up this FX reserve war chest so that on the one hand it can be deployed in the case of need, but also actually to deter essentially rapid capital outflows because investors know, okay, this central bank has very large FX reserves, so probably they have a lot of firepower in the market in case there's stress. And then secondly, it has macroprudential features through the effect of FX intervention. on credit conditions, because essentially FX intervention can lean against unwanted swings in exchange rates and capital flows and their repercussions on domestic credit conditions. And how this works, I will tell you in the following slides. So next slide, please. So first, this slide on the self-insurance element of the macroprudential feature. So what this chart essentially shows is that countries that have very large FX reserves, they also tend to experience smaller depreciations in times of stress. So what this chart shows essentially the link between the initial FX reserve level, which is on the x-axis, and the subsequent exchange rate depreciation in 3 key episodes. So here the blue is the taper tantrum in 2013. Then the red is the outbreak of the COVID in 2020. And the yellow is the initial inflation surge in 21 and 22. And we see here that very clearly countries that had a very large or larger FX reserves, they also experienced smaller depreciations, which essentially reflects the deterring effect that I mentioned, but also obviously the ability to intervene more strongly in such episodes of stress. Next slide, please. And in fact, when we look at the actions of emerging market central banks, then we see that they have indeed actively leaned against the dollar cycle in recent years, for instance. So what we see here is that there were FX or significant FX sales when the dollar surged until October 2022. So these are the red bars here. And at the same time, then there were significant FX purchases afterwards, the blue bars, when then the dollar started to weaken again. So this essentially suggests that FX intervention is actively used by many central banks to lean against dollar swings and associated swings in external financial conditions. Next slide, please. Now, in this slide, I want to elaborate a little bit on the channels through which FX intervention actually exerts this macroprudential effect, this dampening effect on credit conditions. So there are essentially 2 channels at work. On the one hand, there's an exchange rate channel through which FX intervention affects credit through exchange rate via currency mismatches. So this is essentially the financial channel which I have mentioned before. And the second channel is what you can call the sterilization channel, which essentially operates through altering the bond supply, which essentially then affects the balance sheet capacity of the banks and their ability to extend credit. So these 2 channels together, so what they would imply is that a sterilized FX purchase would dampen credit expansion through 2 effects. First, exchange rate depreciation, which would tighten financial conditions domestically. Yeah, basically, when you recall the chart I showed earlier, this would be this effect. And then at the same time, it would increase the supply of bonds to be absorbed by banks or other financial institutions, which would then limit their balance sheet capacity and limit their ability to expand credit to the private sector. Next slide, please. Now, there's also evidence supporting these mechanisms. So first, here, what you see here is some evidence based on aggregate Colombian data. So this is taken from a recent joint paper with Yun Shin and Mauricio Villamizar Villegas from the Central Bank of Colombia. And what this essentially shows is the dynamic impact of an FX purchase shock. And here you see in the left-hand panel that this is indeed associated with the depreciation of the Colombian peso against the dollar. And it is also associated with a significant decline in the stock of corporate loans on a weekly basis. And so this, at an aggregate level, suggests that FX intervention does have these macroprudential features, which I mentioned before. And of course, with the data that we use in this analysis, which are credit registry data for Colombia, which means we are not confined to the aggregate level, but we can also go to firm level, firm loan level, and this is also what we do in the paper. So if you go to the next slide, please. So So what we do there, we essentially test the channels through the data that we have on the firm level FX debt and the data on bank level capitalization. And what the analysis there essentially shows is that the negative effect of an FX purchase on new firm loans increases with FX debt of the firm, which is consistent with the exchange rate channel operating through borrower balance sheets. And it also decreases with bank capitalization, which essentially is consistent with the sterilization channel. Now let me wrap up in my last slide. Just to summarize the key takeaways. So first of all, the first key takeaway is that macroprudential goes beyond macroprudential tools. So the whole policy framework should incorporate macroprudential features in the form of a macro-financial stability framework. Then second, swings in external financial conditions, they raise difficult policy trade-offs and make the case for activation of complementary policies, in particular macroprudential tools, but also other tools, in particular FX intervention, because FX intervention, and this is my third point, has macroprudential features that can help mitigate the trade-offs faced by monetary policy. So let me stop here. Thank you very much.
Thank you, Boris. I think there's two quite interesting additions here. So one is that you've embedded macroprudential into the wider framework of macro-financial policy making, and I think this is something that came up in previous sessions, but now I think you made that very explicit. And second, the fact or the reminder that, of course, macroprudential policy can have also quite important external effects, and I think that's something that maybe in European context we tend to forget sometimes a little bit. So I think we had some quite a rich set of speakers and rather diverse, but many important issues raised. And we have around 10, 15 minutes left for questions. So if there are any questions in the room, please raise your hands.
Okay, thank you very much. Indeed, very, very interesting presentations. We're learning a lot, from your knowledge and experience. I'm Andreas Haridou, University of Cyprus, and member of the board of directors of the Central Bank of Cyprus. One of the issues that we have been discussing today, and you stress to a great extent during this session, relates to inflation and the great variability that we had in the past few years, and Cornelia presented after 2014. And in the past few years, we saw that we had negative inflation, and right now we have very high inflation. And this inflation, as you have already said, may create financial instability, right? And you talk about instruments in order to mitigate this financial instability and create this resilience in the markets. What we observe in the presentations that you made is that this great inflation could be due, you mentioned, possibly to pandemic, or it could be due also to Ukraine-Russian war. One of the issues that I haven't heard, and I need your opinion, is whether QE that started in 2015, something like that, if not mistaken, right? 2015, in the past 8 years, whether it had to do with the inflation that we're having nowadays. The reason I'm saying that, you are more experts than me, whether QE had affected that, is that you mentioned in your presentations that regulators, ECB, Federal Reserve, and national regulators, we have to be proactive. Proactive means that we have to forecast the future and see whether, in the future, whether we are going to have external, unforeseen, factors in order to maintain inflation at a stable rate. And we know the stable level that we want is around 2%. And I wonder whether, both the duration of the QE and the level of the QE affected, the inflation that we have right now, and it could be a possible reason for the financial instability that we may be having nowadays. Thank you.
Thank you very much. Maybe before we answer that question, we can collect a few others if there are other questions from the audience. Yes, please, Javier.
Thank you very much. I found the four interventions very interesting. I'm going to ask first a question to Professor Holmström. I buy very much the idea. As a theorist, I was having difficulties to communicate this idea in the prudential community. It's a challenging idea that there are some assets in the system that must remain information insensitive, and when they don't, we are in great trouble. So, which is also a theory of why somehow ex post is inevitable to go for bailouts when the circumstances are sufficiently adverse. But I was wondering whether we should, in a preemptive way, have the aim to control which securities qualify as money-like or information insensitive. So if when they become information sensitive, we are in trouble, should we actively manage, say, the stocks of what in the 2008 crisis could have been the stocks of apparent AAAs that look completely safe, but they were not? Or more recently, for instance, with reforms to what money market funds can offer to investors, if we introduce instruments such as swing pricing, we are implicitly saying the investors, these securities are not convertible one by one. So in your mindset, and when you decide ex ante whether to invest in them or not, these are not the type of fully information insensitive securities. So I was wondering whether there is a macroprudential policy potentially acting on that dimension. Thank you.
Thank you, Javier. I think we have time for a third question, if there is one. I don't see everybody in the room. Yes, so I think Katarzyna, you have a question? Yeah.
Katarzyna Budnik, European Central Bank. Needless to say, I don't have a question to Cornelia, but I will have a question to Christopher and one for Professor Holmström. So to Christopher, I wanted to ask, because I find like your narrative very appealing. So we have structural changes, be it globalization or climate risks, more volatility, more instability in the transmission of monetary policy. And this brings us to the need of more sudden, sharp adjustments in monetary policy rates. This, of course, has financial stability implications and, let's say, can increase sharply sacrifice ratio. The question is, does this trade-off become less urgent when we recognize that central banks now, in contrast to what was 10 years ago, have more instruments than only interest rate? So I think to a degree we can sterilize our own actions. So I give you just a naive example. We don't run this type of policy, of course. But we can think of a sudden increase in interest rates and at the same time sharp extension of liquidity operations to the financial system. So to say, to shelter the first round effects on the stability of financial system. So this is just a provocative question. I have no sharp opinion on this. And to Professor Holmström, I find your, not hypothesis, but your remark on this fallacy of diversification very telling. And again, a bit of a question for your comment. Factually, the more we regulate financial sector, the more we regulate banks, the more thresholds, ratios we imply on the banks, the more they diversify, but the more uniformly they diversify. So is there something about optimal level of regulation as let's say, via this channel of diversification, because in a perfectly regulated market, all banks would be also identical. So thank you.
Okay, thank you very much. So the way to tackle this, I would suggest that Professor Holmström, maybe you start with the two questions that were addressed to you, then I would give the floor to Chris. And I think the first question is maybe something where Cornelia, but maybe also Chris and Boris, you may have something to say on that too. So Professor Holmström, why don't you start?
Thank you. Both questions terrific. I should have mentioned it, but now it came up, so that's good. Absolutely. If I start with the second question, this is one of the risks I would point to, is that we regulate more, we are going to see more and more similar, banks and higher correlation in the tail. We won't see the correlation until the catastrophe is happening. That's what happened with the global financial crisis. Suddenly, the correlation shot up because we were now seeing the tail risk correlation. So that's one thing, and I agree. I would worry about this excessive sort of detailed regulation where everybody become the same. On the first question about, should we sort of kind of stratify, if you want to put it that way, the various, say, money market funds or something like that. I think, yes, that I think that's, we have to somehow get diversity into the system. That's one of the messages, I think. And it seems like what they did regulatory regulations with the money market funds in the US, you did see that, the sort of the lower quality funds that invested in something else than government securities, short-term securities, then they actually dropped in half. The investors gave up on the idea that this is actually money-like. And that's what I alluded to was very good, because it shouldn't be money-like if it isn't really money-like. And it shouldn't be perceived as money-like if it isn't. So I'm a big, I'm toying very much with the thought that we should get sort of things compartmentalized, and we should make clearer delineations. So the ideal system, in some sense, is something where something happens at the margin, so to speak, where we understand that this is not yet, hitting the really fat part of the bat where we have banks and so on. And that's the warning that we need, the canary in the coal mine. But, today's world is very connected, and this sort of contagion that comes from jumping across the Atlantic. For instance, the CBB is, by the way, an example where it looked like contagion, but it stopped because I think people realized the SVB was rather special. So I very much like pursuing that line that you suggested.
Chris, do you want to take the question now, Katarzyna?
Yes, I think there were two questions. I'll start with the second question posed. Very, very good question. And I think that it's certainly true that central banks have more instruments to be able to deal with financial stresses that might ensue if they raise interest rates very sharply. And I think we have seen how those instruments can be very helpful. So in the case of the UK, they faced trouble with essentially the LDI strategies that caused very large rises in gilt yields. Last year, they intervened successfully to quell that. The Fed essentially provided long-term discount credits to banks under a new facility that allowed lending for up to a year and against very favorable collateral terms. So these are a couple of examples of where tools have been very helpful. The ECB, of course, announced the availability of the Transmission Protection Instrument, the TPI, to guard against this risk. So certainly it makes sense for central banks to have an arsenal of tools to deal with problems and to act decisively using those tools should these risks materialize. But I think my point would be that the preventative aspect is very important, that building a more resilient macroprudential framework can help central banks tighten without getting put into that position, or at least reducing the risk of that. So that, that's really, I think, the crucial point, that macroprudential policy can allay the risk of having to use these tools. And I think, the other aspect that I mentioned is that in some situations, the tools used by central banks might not really be sufficient to deal with the crisis. If it emanates in non-banks, if there are solvency problems, then it almost necessarily involves a forceful fiscal action as well. Then there's another question that was, I think, the first one on QE and whether QE has in fact engendered inflationary pressures and financial instability. I think that in the last couple of years, there really have been a confluence of shocks that have primarily driven the large inflation that we've seen. Probably most salient have been the very large energy supply shocks in wake of Russia's war in Ukraine. And that was, of course, preceded by massive fiscal action, as well as appropriate monetary action to try to stabilize the economy, global economy, in the wake of the pandemic. And that did engender significant inflationary pressures. I don't think really it was QE that was driving it. I think those forces were principal. But it did alert us to the risks that the Phillips curves could be quite a bit more nonlinear than had been envisioned prior to the crisis. We could see potentially, when the economy is near conditions of full employment, that fiscal actions that we might not have thought had to have a big effect on inflation can potentially engender larger effects. And we have to be attendant to that and thinking about appropriate monetary strategies. And so that was my last point at the end. So I think it's certainly important for us to think about what we've learned from this high inflation experience.
Cornelia?
May I come in also on the, I don't know whether...
I think it's not on. Doesn't work, the normal?
I don't know. Can you hear me? I just have to speak louder. Okay, no, thanks.
Perfect.
So on the monetary policy question, let me say it's my own view. So unfortunately, there were members of the Governing Council earlier on, but they have left now. So, no, but I agree with what Christopher said. No, I mean, of course, we have to look into the future, and we have hundreds of people in the Eurosystem and the various national central banks and at the ECB who try to forecast inflation and growth. But we did have two very big shocks, no? I mean, the COVID shock, a worldwide pandemic, and then a war in Europe. So, of course, this had all the effects that we know about supply chain disruptions, and then the energy prices, and with the second round effects that ensued thereafter. I don't think, maybe one element was also that QE was finally starting to work, no, in the very beginning. But so as also people in the Sintra conference in June, everyone was saying how high the uncertainty is because of these two events and how they are scaled back. No, Christopher mentioned the fiscal policies. Now they will be, so now they have a huge impact on inflation, but they will be scaled back. So we don't know. That will also have all kinds of macroeconomic effects, and the effect of QE itself. I mean, I don't think it had a big effect on that. But now, if we think about the transmission of monetary policy, what I think the ECB's estimate is that transmission is working very well. Funding costs of banks are rising in line with the increased interest rates from the ECB side. But what's not rising are the deposit rates. No, and the deposit rates, I think they remain relatively low because there's not enough competition among banks for deposits, and this is because of the large QE. So they all still sit on large amounts of liquidity. So maybe that can slow it down, but I think that now we're also seeing adjustments there. Thanks.
Thank you, Cornelia. Boris, any comments from your side also on this last or first question, I should say?
Yes, let me also emphasize that these are my personal views, obviously. But maybe one observation to add is that there is analysis out there which suggests that the surge in inflation has actually been associated also with very strong demand conditions. So not only with tight supply. So there's the analysis by Adam Shapiro at the Fed, and also some work by Sandra Eickmeyer and myself. And of course, from that perspective, I guess one cannot rule out that QE, together obviously with low rates and fiscal expansion, has been a key factor pushing up demand at a time when supply became very tight. And this combination then brought us to the inflation surge that we are currently dealing with. Also from the perspective of the analysis that was done in the special chapter in the BIS annual economic report, which I mentioned earlier on fiscal monetary interaction, there is at least the hypothesis that we cannot rule out that essentially the long period of very low rates, together with the strong expansion of central bank balance sheets in the wake of large-scale asset purchases, which has been going on for a long time already, essentially since the GFC, together with the persistent rise in debt, basically driven by persistent deficits, that might have driven policies to the boundaries of what we call the region of stability, or maybe beyond, and in this sense has been maybe an important factor behind the inflation surge and also the risk to financial stability we saw earlier this year. Yeah, let me stop there. Thank you.
Okay, thank you very much, Boris. Well, it's 5:10, more or less, so I think we should close the panel at this stage. And let me first of all thank the panelists in person and panelists online for their contributions. And thank you very much for the questions. I think we had a good debate. Thank you very much.
Thank you very much. So before closing this session, I just would like to say for the online participants that thank you that you were with us. And as macroprudential policy is forward-looking, so tomorrow I hope you join us again, because tomorrow we'll have a forward-looking part about the forward-looking macroprudential policy. And all those who are here with us are warmly welcome to the dinner that starts at 7 o'clock here in this room, not because just of the good food, but also because of the very interesting speech prepared by Mr. Stefan Ingves. So everyone is welcome back at 7 o'clock here. Thank you very much.